of a sudden, like everything that I've been building and putting my blood, sweat, and tears, fell apart and crumbled because it was accelerated at that speed. So anyway, I've gone on a few tangents here, but I just feel very strongly about that specific point, and I wish there was a way to solve for it.
Ladles and jelly spoons, boys and girls, welcome back to the 10K Collective podcast for 6 and 7 figure Amazon / private label / e-commerce sellers who mostly sell on Amazon. However you classify yourself, if that's roughly what you do and who you are, welcome to the show. Today, we're talking to Yoni Kozminski from South Col. In fact, from several companies. We'll get into that in a second, but South Col, where Yoni is a founding partner, is a growth fund. We'll talk about what that means, focused on accelerating e-commerce businesses to exit. Now, the difference between them, they're kind of very different from an aggregator because they invest in the entrepreneur to help them grow the business rather than just taking the business off them. So, Yoni, is that roughly right who you are? Welcome to the show, man.
Mate, it is an absolute pleasure to be back here. Thank you for the warm intro.
Yeah.
And yeah, I think it's fairly accurate. We would identify in this day and age as a growth fund, whereby we are looking to invest in e-commerce businesses to accelerate them to exit. So I think you hit the nail pretty well on the head there, Michael.
Yeah, thank you. Well, at the risk of starting to swear on a podcast, and nobody can cope with that in the States, but we're not here to deal with spiders, as they famously say in Australia, only not quite as politely. So, first of all, just explain a little bit about you, because we've had you on the podcast before, but with a different hat on. It wasn't South Col at that point. So, just give us a little bit about who you are and the businesses you're involved in, because I guess that all feeds into the picture, doesn't it?
For sure. Yeah, and it's a good clarifier here. So I'll skip through sort of the majority of my background was in e-commerce, creative advertising, and digital marketing. I used to work with really big brands like Sony and MasterCard and Mercedes-Benz doing their digital strategy, and got really heavily into the Amazon and e-commerce community, growing a brand from 2 to 5 million in 12 months that Thrasio and Aggregator actually acquired. And on the back of that, we started building a couple of service businesses to really help e-commerce sellers accelerate their growth. So one is Multiply Me, which is our executive search and HR function, where we find high level talent in the Philippines and place them in e-commerce businesses, Amazon businesses. And then the other is Escala, which is a process improvement management consultancy. So much like McKinsey, Bain, Accenture, Deloitte, name one of the big consultancies, where we go into businesses and we systemize them to scale or to exit. And we work with, a very large number of aggregators actually helping build most of the ones that are still in play, thankfully. And so that honestly, that's like my background, and that's what I've been up to. And so South Col really is the embodiment of bringing a few of these pieces together, and also bringing in a couple of other key partners. So I'll share that, part of South Col, it's a joint venture. So we brought into this Sellers Funding, who are a capital lender in the e-commerce space, one of the largest ones. And through them and this joint venture and South Col as a business, we were able to stand up a $50 million facility to actually invest money into these businesses. And Global Wired Advisors, who are a leading digital native e-commerce investment bank, where their focus is on selling e-commerce businesses, Amazon businesses, largely to private equity and strategic. So it's my background, the business's background, and how it all converges is that's really the story there.
Yeah, great. So, I mean, obviously, one of the differences that you've got from some of the people out there is, on the one hand, you're not just the kind of classic Amazon entrepreneur who's browsed out into services, such as myself, or on the other hand, you're not sort of suddenly swung into e-commerce with a 5 minute sort of briefing from somebody all about mergers and acquisitions, like a lot of the aggregators seem to, and nothing about operate an Amazon business, it turns out, right? So based on the fact that, as you say, a lot of them are blown up. Okay, so that's interesting. And of course, yeah, we know Global Wide Advisors well. We've had Jason and Chris on multiple times. They're one of my most trusted sources of information, I think, for, how to grow a sellable business, but also the market for businesses, who's out there, who's buying, what are the price points, what are the multiples, that stuff. So that's all very reassuring. Now, tell me about South Col specifically then. So what's different from that, from say an aggregator or, other people out there who are helping in some form to invest in or buy businesses?
Yeah, it's a great question. And how I would first look to define it is, an aggregator, the business model that defines an aggregator is look to identify high value growing in the most part growing brands, e-commerce, digital native brands, and then remove the founder from that business. Their claim to fame is often, we'll see you with cash in the bank 30 days, 60 days, 90 days, very, very quickly. And we will then look to aggregate and create these economies of scale as we scale this business. All of a sudden we don't need as many PPC specialists or designers or, listing specialists and, inventory supply chain. The idea is that you can actually aggregate those into a single, really well ordered model, and that can continue to grow. And that makes a lot of sense, in theory. I think what we found is that it's a little bit harder than, a lot of these people who looked at the unit economics and the numbers around it to actually manage. And that's because all of these Amazon and e-commerce entrepreneurs are so committed and dedicated and brilliant at what they do. And they are, in many ways, the secret sauce and why the business has gotten to, you know, 500,000, a million, 2 million, $5 million in revenue and growing at these pace. It's their level of commitment. And when you take that piece out, things change. And so leading into what is South Col is effectively the business whereby instead of taking that founder out of play and saying, right, we'll take it from here, we're going to turn this into a big boy or big girl brand. What we're actually saying is you are the most valuable asset in this business. And while maybe you don't have all of the experience in the world in growing businesses to the level that they can actually materialize, or you don't have all the resources, what we're actually going to do is we're going to invest millions of dollars, depending on what the company needs, into your business. We're going to build you a 2-year roadmap where you are going to maximize your exit potential and what that multiple looks like. And through this journey, what we'll effectively do is we'll build out the processes where we look to remove you from, honestly, all the things that you likely hate. And those are things like PPC management and inventory and supply chain and logistics headaches and things like that. And we'll have you focused in on doing the things that make you truly great. So things like new product development, working with manufacturers to do testing, building out the next 10 products that you'd like to bring to market, or expanding your brand and your operation into new regions, things that will actually have impact on the multiple and things that you will really typically enjoy as an e-commerce founder. And ultimately, what we're looking to do is say, let's have you focus on the things where you create the most leverage. Let's give you as much money as you need to invest in third-party providers like PPC agencies that, live and breathe this stuff, or design agencies, or a full service agency that can help you, or a 3PL, or IP and patent lawyers, or things that are really going to help drive the brand while it's growing and grow the brand likely better than you can, while you can focus on the things that are really going to turn the screws from a multiple perspective. So I know I've gone on a little bit here, but I think it's a really important question and distinction to make, because that's the question that you often get. Like, well, you're just an aggregator, right? And I think that it's unclear at the start, but once you understand how this is involved in actually growing the individual and also the brand, it's very different. I think one of the really important things to finish off on here is that we're committed to the outcome. So this isn't transactional. This is how we make money. To be totally transparent, is we take minority stake equity ownership of the business. So you don't pay for any of the services that are being rendered. You don't pay for the investment bank's involvement or for the years of management consulting and the roadmap that we build with you and any of these things that go into it. What we're saying is we will see upside when you see upside, and we're directly aligned with what that looks like, including like having a hurdle. So if we don't achieve what we commit to achieving, then we ultimately bear the biggest loss here, because we will have obviously likely grown the business, but we have to grow it in a material way.
Yeah, interesting. So I just want to say one thing to anyone who's listening. He's talking about his own business and the structure they have. I think it's really important to remember that, this is an education-based podcast. Yeah, sure. All guests are going to be invited to tell you who they are and what you do if you want to go further with them. And why would we not? But I think it's really important that anyone listening thinks about this from an abstract point of view. The business models that are out there, the business model you're operating has a profound effect on everything about your business, right? But the business model that the person who might be buying or investing in your business, or for that matter, lending you money, any of those things, has a profound effect on that relationship and thus on everything about your business and how much you sell for, how stressful your life is, how big the business gets, whether you sell the business to somebody who then tanks it, which is sadly being quite a common story. So I just wanted to say that so that everyone listening keeps an open mind and takes, even if they never work with South Col, takes the learnings as it were. So I'm all about that. So I just wanted to say that. I think the interesting thing is that this situation is where you and the entrepreneur are much more aligned because you're both going to benefit in proportionate terms equally from the exit. Whereas when you're dealing with somebody across the table who's buying the whole business from you, obviously it's in their interest to have the lowest exit price possible, right? And your interest to have the highest. So I guess that's one of the things we should think about. I mean, let's back off a little bit from the immediate South Col thing and just look at the wider market for businesses first of all, and then we'll talk about growth and whether that's even a good plan. But let's talk about the
Sure.
wider market. It's quite famous that the aggregators have sort of went up and then went shooting downwards. What's your view on the market right now for actually selling an e-commerce business in a more conventional way?
Yeah, yeah, absolutely. Well, let me just take a step back and say, nothing I'm sharing today is about pitching anyone. I think it's really important, like you were pointing out, Michael, to understand the difference in the models. And, a lot of the logic behind it came on the fact that, in we deal with hundreds of clients across Multiply Me and Escala. And many times investment banks, brokers, and a lot of aggregators that we work with would approach us and say, hey, like just, particularly aggregators, like any businesses that fit this and this size, like send them our way. And I was, I never felt good about that because I'm effectively saying the client that I'm servicing, the person that I'm genuinely helping to scale their business, to staff their business, to help them create these these material wins in their life are now in a position where the introduction I make for them is trying to buy their brand, their asset at the lowest possible rate. And my client is trying to now sell it at the highest. And so it was a real just conflict of interest. So through this whole process, and I'm about to answer your question in a second about, what happened with the aggregators, but I think that looking at the different business models and understanding that is just fundamental for you guys also to just think like, how can I apply this to my business as well? And are there opportunities that exist that make a whole lot of sense? So coming back to the question that you asked, Michael, about like what's driven a lot of the aggregators, explosion and growth, and then, obviously some of the challenges here. I think many factors that happen. And I think like the story around Thrasio is a very interesting one. So for those of you who don't know a Thrasio, and if you're in the Amazon space and you've been living under a rock, I'll share with you, Thrasio is the fastest profitable unicorn in the history of the world. There has never been a company that has grown faster and to a level of profitability in history. They went on to acquire, the model was acquiring these FBA businesses, doing them and operating them. And they went on to acquire about 250 or so businesses in the span of under 4 years. They were bringing on 100, in some weeks, 100 people a week. And they went from being the fastest profitable unicorn in history to burning cash and going through, a very public restructure at the end of last year and, have continued to evolve and iterate. And I think like the couple of lessons here. One is it's extremely hard to scale any business at speed. And this is coming from someone who has a process improvement consultancy where we still get things wrong and no one is impervious. And so trying to go, at 100 miles an hour from day one is never a good idea, in my opinion. And what's more is, because a lot of people saw what this model was and the appeal, call them spreadsheet jockeys, if you will, the appeal of what this could look like in a material IPO or liquidity event, it drove up all of this immense demand. So sellers who were selling their businesses were the biggest winners over the last, let's call it 2 years. The multiples went from 1.5 probably when Thras started acquiring to 7, 8, 9 times EBITDA. And so there was a lot of capital floating, things were happening. There was also a lot of market distinction or market confidence suggesting that like, I remember hearing in 2020, at the start of 2020, e-commerce has gone 5 years into the future or 10 years into the future in like a matter of months. It's crazy, the growth. And I think a lot of it was just the fact that we were all inside and we couldn't spend money on all the other things that we'd like to spend money on. So people were investing in things online. And so,
Yeah.
that was a big part of it. Like it was a somewhat of a perfect storm
Yeah.
that sort of came together to result in this outcome.
And one of the things that's always struck me about that, if something grows by 5 years worth of what you projected, i.e., if you're expecting e-commerce, if you think of that as an industry in itself, as opposed to a subset of retail, to grow at say 15% a year or 12%, the sort of average is, and it grows, whatever, 50, 60% in one year. There's this thing called the reversion to the mean that over the decades, I'm no genius at statistics, but it seems as a rule of thumb, very reliable, like the 80-20 principle. I tend to look for that pattern because I find it turns up. So in other words, if it grows 50% in one year and the average trend is 12% a year, well, if that average is going to continue over 10 years, that implies it's going to drop like a stone for the next 2 years and then not grow very much for the next two. So that doesn't mean that the long-term trend has changed, right? But it just seems weird to me how people kind of who know a lot about markets and spreadsheets and have finance degrees ignore such a primitive but famous statistics thing. I mean, what's your take on that? Why first of all, do you think that's a what happening, the reversion to the mean thing in terms of e-commerce growth trends year on year revenue? And secondly, why do people ignore that? If
So I would say a few things. In a lot of these situations, speed to market and doing this first gets you, you know, not everywhere, but gets you pretty far. And so the fact that Thras had such a jump on so many of these other businesses, put them in really good stead. And you saw they were the fastest profitable unicorn in history. Now, I think that just the sheer duration of the pandemic had a pretty significant impact here. So it wasn't like this 3 or 6 month journey here. We're talking about years worth of this build up and of this sort of consumer spending pattern. And then we've had from the consumer spending pattern, it's a perfect storm. We're also finding ourselves in heading toward a recession. And so I think like all of these factors combined have really created those challenges. I mean, you literally saw like these massive M&A teams all let go of in, I would say most of the aggregators. And that just shows that, venture capital is, this is a whole topic that we could go into, but venture capital frustrates me in terms of the model. Like, there's so many great entrepreneurs that are likely absolutely burned because they tried to go really big. Like venture capital's goal is to force an outcome, good or bad. They hit 1 in 10, 1 in 20. It's not a huge hit rate, but that hit will typically pay for all the other failed, investments in their portfolio. And so coming back to it, like you've got 100 odd aggregators, and it was always known that only a small percentage of them would make it through. And now, I think about like what would that do to my confidence as a founder, as an entrepreneur, if an outcome was forced upon me, I didn't hit it, and all of a sudden, like everything that I've been building and putting my blood, sweat, and tears, fell apart and crumbled because it was accelerated at that speed. So anyway, I've gone on a few tangents here, but I just feel very strongly about that specific point, and I wish there was a way to solve for it.
Yeah, you make an interesting point. And again, it comes down to a couple of things, I think. I mean, again, it comes down to understanding the dynamics in a situation. They're often quite straightforward, but people don't understand them because it's not their world. So if you're a venture capitalist and your world is you invest, like Shark Tank, for example, most famous example of sort of playing at venture capital. I mean, those people are serious entrepreneurs, don't get me wrong, but they do it for TV. And I've worked on a bit of reality TV in the past. It's about as real as a soap opera, but nevertheless, the basics are there and their outcomes are shocking. Like I think 1 in 30 of those have actually returned their money or made a profit. So, okay, that's probably particularly terrible because they're doing it for TV reasons. They're already wealthy. Let's say 1 in 10. I think that's probably good. In that case, that implies they have to go for broke or kill your company. And I guess for them, it just doesn't matter if it kills the company. And if you go in understanding that as the entrepreneur, I think that really changes your decision about whether to do it, how you work with it, and whether you expect to have a job as a CEO as distinct from majority shareholder, right? Because I've seen so many CEOs being ousted from their companies, had conversations with them. I know them privately. Somebody, I don't have the right to talk about it publicly, but I happen to know the CEO or the former CEO of a very big marketplace as a marketplace as a distinct from a brand that was acquired. And sure enough, within about 8 months, she'd lost her job because they probably expected her to 4x the company to justify to my mind, outrageous multiple. of revenue, never mind profit, that they paid. It was ludicrous. I mean, I cannot think what the multiple was now. It was like 20 times revenue. I'm like, really? What are you doing? So how do we, in that, you brought this up, but we're going down this, it's not really a rabbit hole. I think we're going down an interesting tangent. Tell me, how should an entrepreneur even think about that? How do they begin to make decisions in that kind of shark-like environment?
Yeah, it's a great question, and honestly, like when I think through the vision of what we're looking to create long term, I hope to, I don't know, necessarily be a solution to, but be another option to that opportunity. And I'd say, South Col for me is the most important stepping stone in my career to date, and what it means for the founders that we'll work with and support, and what that journey will look like. But I think when I sort of take a step back and I look at that environment, for anyone who's like considering taking on venture capital and going through that process, which it's crossed my mind plenty of times through this journey. If I had more I'm a bootstrap founder. If I had more capital, I could accelerate the growth of, our product team and the technology we're building. And I could do so much with that money, but with it comes, a real cost. And that cost is the fact, and forget the equity that you give up. I think that, you'll be able to find whatever that split looks like and you'll make that work, and that's fine. The problem that I face is that you effectively lose that opportunity to dictate the outcome as to where your business is headed. And for me, that's scary only from the standpoint that like you as a founder, me as a founder, we're not going to get it right all the time and probably not most of the time, but sometimes you hit on these things that we're never in the very structured plan of like, this is how, if I had raised capital, for example, for Multiply Me, which is a staffing business, I never would have been able to have the opportunity to build a Scala, which is a consulting practice. And that happened by accident. And the reality is like that business is the most valuable asset that I have today and was what led us to South Coast. So coming back to it and just around this whole venture capital opportunity, like you just have to remember that these guys are trying to 20x whatever it is you're doing. And while that's really exciting as a founder, there's no shame in building like a really high value, cash flow positive business. And, while I'm passionate about what South Col is, I'd also say to any founder, like selling your business isn't necessarily the road that you should be taking. That, this is not like the be all and end all and like, I think people wear it as like a massive badge of honor. Like I exited a company and, if you had a massive liquidity event and now you're, in a really healthy financial position, amazing. But you can build a really viable business and not have to go down this venture capital route or sell it and go through it. So coming back to like how I see ways that you could build a different line of opportunity. And I'm starting to see a lot of agencies take this path too. When I look at it from my lens, like Escala can understand, fix, and build any business, and Multiply Me can staff it with high value, low cost talent. And so, like the dream state for me would be to actually give entrepreneurs building great businesses the resources that I never had when I was starting out, and say we're going to invest into your company. We're going to give you all the resources you need to get there and build like a partnership where it's not about exiting the business, but whether it's rev share, whether it's about owning equity, like finding something that actually has longevity and sustainability and makes sense for everyone because we're helping each other create the best possible outcome. So another long-winded answer for you.
No, but this stuff has got to be thought through. I have a few things that make me despair a bit about the e-commerce industry. Despair is too strong a word, but sort of wind me up, because I feel a lot of stuff induces poor quality business thinking. And what's interesting is there's plodding business thinking that actually maybe not be sexy, but has a lot of value. And a lot of people just bypass that because they think they bypassed it by being clever. Then there's that terribly, superficial, we think we're being clever by the latest hack, which I think is doomed. And then there's actually genuinely smart acceleration strategies, but which require real understanding. And I think this is the thing that we've got to get right. So I would say what's interesting about what you propose, and you're not the only people to do some similar deal structure. There are a couple of private equity companies that have been on the podcast before, invest in the business, but not take it off people, a minority equity position, and then help the founders grow it. What's interesting there is the dynamic is your interests are clearly more aligned. than if somebody just, wants to accelerate your business along with 10 others. So let's move on slightly from the whole question of selling or not selling the business, because in a sense, that's kind of well, okay, let me ask you a question. I'm about to make an assumption, which is the mother of all F-ups, as we know. Is there a difference between accelerating your business growth for you to own it in the future versus accelerating it to sell it, or is growth just growth?
Yeah, that's a great question. I think the first standpoint, like the South Col model specifically, it come with an exit 2 years on. Like that model is tied to an exit. If you're asking the question about sort of, what does that look like from a accelerating a business for growth versus for exit, I would say that it really comes down to what does that relationship look like for you, and what's more important is what is the business model that you have, and what is the big payday. And I'm just going to give you like some tangible examples. If you're in a business like I am right now in a service business, and I'm going to use Multiply Me, then typically with service businesses you can build healthy margins once you get to what I like to call like critical mass, and you build a level of operation and sophistication where like that thing should just run and run independent of you, and it should be really healthy cash flow. Again, once you get there, we're not quite there yet, but hoping to in the not too distant future. Like there might not be any real material reason to sell a business like that if, let's just give the hypothetical. Let's say my dream state, let's say that business could yield me $300,000 a year that I could take home where I didn't have to work in it all that much. Like, sure, it would sell for a decent multiple, but what's the point if it runs and it's fairly low touch for me? Unbelievable. There's no real critical reason to have that big exit. I'd say the reason why I think exits are talked about a fair amount, or more so than necessarily other industries in the e-commerce space, is that to grow an e-commerce business, it's extremely cash intensive. So as you grow, and as anyone listening in here will understand, like as you grow and you're looking to understand your cash conversion cycles and your order value, the cost of orders and the lead time and your ability to sell, like as that business grows, so too does your requirement on cash. And so ultimately, like you're growing a business, it's a great business, but there's a level of stress attached to that. And you're constantly having to, borrow money in order to fuel the beast that you've created, unless you build like really high profit margins into it, which is not typically the case. So that's why I would say when you look at an e-commerce business, like exiting an e-commerce business makes a lot of sense in a lot of realities, because especially when we talk about FBA businesses, like there's that FBA marketplace risk that's attached on top of everything else that's going on here. And this is me as someone who's investing in these types of businesses. I know all of the concerns and what that looks like. And I would say like these are the things that you should be considering as to like when you're building your business and the decisions you make around your model, and whether it's e-commerce or consulting to e-commerce businesses or service businesses, like really just understanding like what does the lifestyle look like, and what is that upside opportunity?
Yeah, I think this is seriously important. So a couple of examples spring to mind in terms of the service slash lifestyle business. James Schramko, who I've mentioned to you, a fellow Australian, if you count yourself as Australian these days, but who has built a rather nice business, and he coaches other businesses. It's service based. It's relatively light touch. He spends a lot of time surfing. It's kind of like the pitch for Amazon private label from like 2014 when I got into it, but actually it makes more sense. Whereas the other example that springs to mind is Shoe Dog, the Phil Knight's book, which of all business books written by somebody from a big corporation is incredibly listenable. I mean, I think he lost his son. I think there was something special about that book, but I would recommend anyone listen to it. But the main thing that strikes you is the financial journey for like 12, 13, 14 years. He just fought his bank to borrow more and more and more and more money. And on paper, Nike, he was doubling sales every year. And on paper, everyone wants that. And in practice, it was just massive stress, and they didn't take much personal money from it until he went public, which is effectively selling it in pieces to millions of people, right? So that reality is independent of e-commerce, I think, and it's independent of digital versus non-digital. I think it's retail, isn't it? You buy stuff, your money's tied up in stuff. When you sell the stuff, you go, great, thank God I got some cash. Only you're selling more stuff, so you got to buy even more widgets. And thus it continues, right? The only way to get off the treadmill is to sell the thing. So I think you're right. I mean, I know one or two people who I don't think they're going to sell in their life. They, for good reasons, I mean, They often have like a multi-generational business that they want to pass to their kids, and they have a big appetite for risk. Exactly like you said. Everyone else I know, and they say they're not going to sell, I look at them, I'm like, I don't think I believe you, because I've heard people say that before, and then the next month they've come back and said, "Oh, Mike, I've sold our business." I don't know if
You,
you've had
you
those
know,
conversations.
I mean, you know what they say, mate. Money talks and bullshit walks. I mean, the reality,
Yeah. When the
you know,
multiples are like 5 or 6x for a pretty ordinary business, yeah. I mean, like I had a couple of clients sell businesses, one in January 2022, was it? It feels like decades ago, because the world has changed, right? The
yep.
Ukraine war and the marketplace. So tell me, let's talk a bit more about the accelerating growth thing. The other question, even more profound, is should you even accelerate growth? Because, I guess it implies if you're going to exit, you need to do that, but there are obviously downsides. So what are the cautionary things where you should think twice about growth?
Yeah. Well, I would first look at, and you sort of alluded to it before, but like the current state of the market. So, this time last year, you were seeing these absurd multiples. Sellers were laughing all the way to the bank, five, six, sevens, eights, nines for businesses that are, $1 million EBITDA. So let's call it a three, four, $5 million revenue business, and even smaller than that, getting these really, really beautiful payouts. And the businesses might have been around for 2, 3, 4 years. It's not an extensive amount of time. It's an amazing, amazing opportunity. If we look forward today, and I've spoken to a number of the marketplaces and brokers and investment banks. You're looking at multiples now for businesses that are even larger than those at maybe a two. So $1 million, a $500,000 business, EBITDA business last year might have sold for a 4 or 5 multiple. You'd be lucky to sell $1 million EBITDA business for a 2 times multiple today. And so I would say that's the current state of what's going on. And when we look at like accelerating growth, you've put all of this blood, sweat, and tears into building this business. And like we were talking, like you gave the example of Shoe Dog and Nike, you you typically, unless you're building the right profit margins into this business, and it's not about, beg, borrowing, and stealing money to be able to keep the lights on, typically with an e-commerce business, the goal will be to exit it. And so if I was asked today, like, should you sell your business? I'd say unless you're hitting, 2 million EBITDA, unless it really is niche specific, you have defensibility around patents and IP, and there is like a real private equity or strategic buyer that you understand and you work backwards understanding that this is exactly the asset that they would be looking for, then I would say it's probably not the best time. And so then you have to look introspectively and say, well, what can I do now with this asset? I'm 2, 3, 4, 5 years in. I've put in all of this hard work, and how do I approach that? So I would say, I think when you accelerate anything, it should be very intentional and it should be fraught with caution. So don't just try and expand it, and examples might be like, don't just try and enter the UK and Europe at the same time, entering D2C and wholesale and retail, and then try and bring, 50 new products to market when you only had 5 in market, and doing all of this at once when you're especially like a solo founder or you have a very small team. Like, I think one of the things that I've learned in my career, and also as we go through this process in the businesses that we've invested in, it's very, very intentional. You're working backwards from your defined outcome and your objective, and how the business needs to perform and what it needs to look like 2 years on. So I think like my piece of advice here is to really understand, like, what does the business need to look like for it to make sense for a potential acquisition in whatever 2 years time from now, or as the market shifts, hopefully sooner. But we'd predict at least another year in this current climate. And it's so unpredictable right now. So we could chat in a month's time right now, and the basis points might have shifted, and we're looking at a very different reality, and it could be scary or it could be better. So I just say, like, just being very intentional at this moment in time, and starting to really get clear on where you'd like to be through this journey.
Well, folks, there is a lot to take on board from today's interview. What I would say is this. Um, growing a business to sell versus growing a business that you would love to own or pass on to your grandchildren. I literally have had some business owners work with me in the mastermind they're like 8th generation of the family business, right? Whichever it is, let's not get distracted. If you're growing any kind of business, the discipline of creating a sellable business will be fantastically good for your business. That's the first thing I would say. So I think you should listen to everything that Yoni has to say. The guy is super smart. And, he worked not only in his own business, but actually also with a lot of e-commerce operators. And he's a management consultant and he's working with investors. So the guy has a great general sort of strategy perspective. Plus he's really sharp, in my opinion, why I've got him on as a guest, right? So things to think about. Who are you in your business? What's your view on the market right now? You got to go and educate yourself. Hopefully today is part of that. Learn the lessons from the Thrasio story and the aggregators and the venture capital model and the downsides and the risks of that. And then the other investment options. South Col has a fairly unusual but not completely unique investment approach where they will work alongside you and invest with you. There are other people we've had on the show and there are other people that my clients are working with right now with a similar sort of approach. That's not typical, but it's out there. So you should educate yourself about what's out there if you're planning to sell. Really, accelerating growth is what everyone I know is obsessed with. All I would say is this: if you're going to accelerate the growth of your business, think about why. Where are you going with it? And who's going to benefit from it? Because if you do it the wrong way, Amazon will benefit because they'll take your fees, and your clients will benefit. I mean, the customers, because they'll have lots of lovely products, and your suppliers will benefit because they will be buying, taking your money in exchange for selling you the products to sell on to your consumers, right? But make sure you get paid. And the biggest way to get paid in the business model where you have a lot of money tied up in inventory is to sell the asset to somebody normally. You don't have to do that, but you do need to go with a plan. If that's not what you're going to do, that makes sense. So hope that makes sense. Don't forget, if you like this kind of show where we get a bit more in depth and we're a bit more strategic than just the tactical stuff that's out there, then don't forget to subscribe on the podcast player of your choice to the 10K Collective podcast or Amazing FBA podcast, whichever floats your boat. 10K Collective is focused solely on the needs of 6-7 figure Amazon sellers. That's mostly what I focus on these days. The odd episode comes up in Amazing FBA that isn't focused on that. So that's who we are. That's what we do. Thanks for listening. I've been Michael Veazey. You've been great. Speak to you in the next show.